After we topped March off with some higher highs in the stock market, it was certainly a lousier start to the month of April, as we found ourselves in the red. But thanks to all the market pessimism, there were plenty of buying opportunities this past week, to which that's exactly what I took advantage of, spending over $2,000. So today, I want to go ahead and run you through all the need-to-know macroeconomics so you can at least understand what exactly happened, and then share with you which positions I doubled down on this past week should you want to follow suit. With that, let's dive right in. So as we always do, I want to get kickstarted with our macro bites to understand how exactly we came off of such a strong market high and in a mere matter of days found ourselves trembling in the red. Now, of course, what goes up must come down, at least eventually. So anyone could have seen this little shakeup coming. But one of the primary causes that sparked the sell-off rather recently has been the ADP report. It came out this past week, which depicted a massive jump in jobs in March, whereas we expected around 150,000 private jobs to be added to the private sector, yet the report read 184,000 added. That was a sharp increase, not to mention wages also increased by roughly 5%, which actually all sounds like pretty positive news, and it is, depending on how you see it, the role that you're in, and ultimately where you'd like the economy to be. And therein lies all of the trouble. Well, yes, a robust economy is always well received by the masses, all of us. There are times like right now when the Federal Reserve is looking to cool the economy to really get a grip on inflation, which, as we all should know by this point in time, is upwards of around 3.9%, which is quite a ways away from that 2% inflationary goal, which is all perhaps not so great, which is what market participants were reacting to. Because a hot economy means the prolonged elevation of interest rates, which is keeping all the bulls in their pens. And this all just continues to beg the question now of when interest rates will actually reverse course and come down, which would ultimately fire up businesses to spend without a monetary chastity belt. But until then, we will likely just continue to be in choppier market waters. And if you're asking where exactly you should be investing, well, I say either continue to dollar cost average into broad market ETFs or stick to high quality stocks that will likely be alive and well in a decade's time. At least that's how I decided to spend over $2,200 this past week, with my first no-brainer investment being the Vanguard Total Stock Market Index Fund, ticker symbol VTI, which, yes, it does pay a small dividend, but moreover allows me to capture plenty of growth, as the fund's objective is simply to track the performance of the US total stock market, and it does exactly that with some 3,731 holdings within it. Gives plenty of exposure to me across sector verticals. We can see 32.3% of the fund's weight is in technology, whereas another large sum gets even safer here with consumer discretionary coming in at 14.5% before spilling into the industrial sector at 13%, healthcare at 12%, and financials coming in at about 10.7% worth of the fund's weight. But for me, it always helps to peek into what stocks I'm actually investing into when I invest into VTI. So we have Microsoft and Apple as the top two, Nvidia, Amazon, Meta, Google, Berkshire Hathaway, Eli Lilly, and Broadcom as the top 10 holdings. Dividend-wise, we're talking about a quarterly dividend payment here coming in at a yield of 1.29%, an expense ratio at just 0.03%. That means you're going to pay $3 per $10,000 invested annually. But here's the real magic of VTI working in our favor. Though the fund slipped up this past week, year to date, it's up by 9% already. And over the past decade, get this, we've seen over 220%, which is exceptionally well considering you're never really going to lose a night's sleep when you're invested into VTI. So I spent a total of $513.50 buying 2 more shares worth of VTI for my portfolio. That was really just the beginning of my shopping spree, because I also scored more shares of the Vanguard Information Technology ETF, ticker symbol VGT, spending $1,032.46 on this one for 2 more shares, given I believe in our ever-advancing future. So this fund that specifically seeks to track the performance of a benchmark index that measures the investment return of stocks within the technology sector really becomes the ideal for me, especially with the 315 holdings that grant me plenty of diversity within the tech sector alone. As we can see, 25.6% of the fund focuses on semiconductors, the hottest commodity of our time, before then granting all shareholders with exposure to system software coming in at 23.8% of the fund's weight, as well as 18.2% in tech hardware, 14.9% in application application software, and 4.2% back in the materials for semiconductors, which works out to holdings like Microsoft and Apple, Nvidia, Broadcom, AMD, Salesforce, Adobe, Accenture, Cisco Systems, and Intuit. But given it also slipped up on the week, I went ahead to take that little bite and applaud the fund's momentum, up by 7.81% on the year. But zooming out, check this out, we have 546% worth of share price appreciation. Now, VGT pays a small chunk of a dividend at 0.54%, but this one I'm mainly in for the growth and confident that it's just going to continue to deliver an expense ratio of just 0.1%, meaning you're only paying $10 per $10,000 invested annually. Now, investors, those were the two funds that I scooped up more shares of this past week. And before I actually dive into the individual stocks that I loaded up on, I want to go ahead and talk to you about taking massive action right now. That's all you have to do is subscribe to the channel to join the journey and be a part of this. You're not only going to have my word every single week on the macro insights, but brand new dividend stock ideas every week. And while you're at it, I also want you to tap on that thumbs up button if this is the value that you were looking for when you initially clicked on this video. With that, we'll get back to it here with Apple, ticker symbol AAPL, which I'm doubtful even needs an introduction. But I want to highlight that Apple just isn't having a great year whatsoever. As we can see, the stock share price here is down 11% year to date after very weak performance as of late. But think long term, as Apple has delivered almost 1,000% worth of appreciation over the last decade. And given the future is very tech oriented, Apple's future is bright. Now, Apple is a tech leader entering the home robotics space, likely to have a very strong footing in AI as well, and much more. I remain confident along with all the analysts out there who say Apple is a buy, to which analysts foresee a share price coming up to $201.53 per share. That's about 18% worth of upside. So I went ahead to buy another share, $168.38 spent there, bring my share count up to 128 shares. And while we wait, we're going to enjoy a dividend coming in at a 0.57% dividend yield from Apple, while growing on average year over year by 9%. But I also went ahead to score some more shares worth of Visa, ticker symbol V, which is a major stock in focus for me this 2024 for multiple reasons. The first of which is their business model as a transaction facilitator and not a lender, which provides me with plenty of safety. But also, as we enter the future with transaction technology rapidly changing and Visa as an industry leader loaded with all the means to see through and lead us to better technology, it just is a winner in my book. So this past week it slid to $276 per share, and I couldn't help myself but buy two more shares, picking up those two shares for $557.84. That brings my share count up to 15 total shares worth of Visa. Now, all in all, I want you to note that Visa is up on the year by 6.5%. And zooming out, we can see over 486% worth of appreciation, while analysts remain optimistic, forecasting 11% more worth of growth. That comes up to $310.06 per share. But until then, you're also going to be able to enjoy some growth and some dividends here at a 0.75% dividend yield that's been experiencing an average of 18% worth of dividend growth year over year. And there you have them all the buys I made this past week. Let me know what you've been buying, or moreover, if you're just hanging out and waiting for better opportunities to come our way, let me know what those opportunities are. Until then, subscribe to the channel or just click right on through for more insights here.